and welcome to Business Weekly. The Federal Reserve surprised many by saying it would continue to pump money into the U.S. economy. The Open Market Committee is not tapering the pace of its bond purchases. Markets jumped to fresh highs, though the Fed has cut its growth forecast. But Bernanke said the economy is still too weak for any change now. Similar sentiments were expressed by Barack Obama in his speech on the 5th anniversary of the financial crisis. The U.S. president warned congressional Republicans that they could trigger fresh economic chaos. But of course, the financial crisis was not only in the U.S. Europe is still struggling to overcome its consequences. However, the region's governments are moving to sell their stakes in bailed-out banks. We'll discuss all that with Neera Chage from Bloomberg later in the program. First, let's have a look at the unexpected decision from the U.S. Central Bank to do nothing.
In a surprise move, the U.S. Federal Reserve has announced that it will not be touching its stimulus measures and will continue buying bonds at a pace of $85 billion a month. Fed Chairman Bernanke is concerned a rise in borrowing costs could weigh on the economy.
Eliminated, with unemployment still elevated and inflation projected to run below the committee's longer-run objective, the committee is continuing its highly accommodative policies. As you know, in normal times, the committee eases monetary policy by lowering its target for the short-term policy interest rate, the federal funds rate. However, the target range for the federal funds rate, currently at 0 to 1/4%, cannot be lowered meaningfully further.
The announcement surprised financial markets, which were expecting the Fed to take its first tentative steps towards winding down quantitative easing. The Fed cites strains in the economy and higher mortgage rates for maintaining its stimulus. The move comes against a gloomier than expected outlook for economic growth in the United States.
Few people expected the Fed to leave its policy unchanged. Neera, why was that, and when might it start to wind down stimulus?
Indeed, Fed Chairman Bernanke really did the unexpected by doing absolutely nothing. And it's true that few people expected it. One economist said he was just stunned and confused. Now, it was a surprise because there have been some signs that the U.S. economy is strengthening. But Bernanke had his reasons. He said the Fed has to determine its policies based on what's needed for the economy, even if it surprises markets. He said he was concerned that rising market interest rates would curb growth and that he wanted to wait a bit longer and try to get confirming evidence that the economy is showing signs of lasting improvement. And you know, the decision to abstain from cutting back on quantitative easing, to abstain from tapering, as it's called, really underscored Bernanke's willingness to do anything to lower unemployment. In terms of when the Fed will taper, well, some economists are saying December, others are saying March. It's really anyone's guess now. There are markets soared to new highs, but surely there is nothing to celebrate, as the Fed's decision means the recovery is still weak. Look, this is where we get into the issue of good news is bad news and bad news is good news for the markets, meaning that markets get excited about continued cheap money from the Fed rather than about economic growth. Some analysts say investors really have become addicted to that cheap money, to that liquidity. Take Europe's equity benchmark. That's gained so far this month and so far this year as central banks around the world have pledged to maintain stimulus measures to support the global economy. What Bernanke's done now is reassured markets that the Fed is committed to providing support. Also, the Fed hasn't said that the U.S. recovery is weak, it's called it modest. The impression that Bernanke gave this time is simply that he wants to make sure the recovery is sustained.
5 years after collapse of Lehman Brothers, a symbolical moment of the financial crisis, and a perfect time to check what has changed. The U.S. president said that back in 2008 it was a perfect storm. And he warned, it's not over yet.
5 years after the start of the global economic crisis, President Obama has used the anniversary for a blistering attack on his political opponents, warning it would be the height of irresponsibility for Republican lawmakers to push the country back into recession.
By the time I took office, the economy was shrinking by an annual rate of more than 8%. Our businesses were shedding 800,000 jobs each month. It was a perfect storm. over the last 3.5 years, our businesses have added 7.5 million new jobs. The unemployment rate has come down, our housing market is healing, our financial system is safer, but that's not the end of the story. As any middle-class family will tell you, or anybody who's striving to get into the middle class, we are not yet where we need to be. And that's what we've got to focus on.
The warning came as the White House geared up for brutal partisan budget negotiations with Congress. The slow recovery from recession has been a difficult challenge for Obama. Opinion polls show many Americans are not convinced the economy is on the mend.
Europe is still suffering from the crisis aftershocks. Many banks in the region needed help in 2008-2009, being saved by European taxpayers. The British government has sold part of its stake in Lloyds banking group. Belgium may do the same with holdings in BNP Paribas.
Financial analysts and the British government have been toasting the success of the part re-privatisation of Lloyds Banking Group. The first sale of taxpayer-owned shares raised the equivalent of €3.8 billion and marked a milestone in the UK economy's recovery from the 2008 financial crisis. Profit for the government was a modest €73 million, but
it's very important for the government that they've got a profit, and I think it's very interesting that they only sold 6%, and there's still over another 30% to go. So they obviously feel quite confident that things are going to get better.
There was big demand for the offering, and Britain's Conservative-led coalition government is expected to sell more Lloyds shares in the first half of next year. And some economists think the finance minister will try to make a political point by selling all of its stake before the next election in 2015.
The UK government is expected to sell more Lloyds shares and is making a profit. Other European countries are set to do the same. Will the taxpayers get their money back?
Well, the UK government made about £60 million or $95 million in profit on a first sale of its stake in Lloyds. Now, that was about 6% of the company's issued stock. The shares, though, were priced above what the government paid when it provided a £20 billion bailout in 2008. And according to a person with knowledge of the sale, it was about 3 times oversubscribed. So there was high demand from investors. Some analysts are saying it's the first step of triggering a virtuous cycle. But you know, Alexandra, it's too early to say if taxpayers will get their money back, because the UK Chancellor George Osborne has said that Royal Bank of Scotland, which remember had the biggest bank bailout in history, RBS is still burdened, George Osborne says, by too many poor assets to be sold.
That was Neera Chich from Bloomberg. Thank you, Neera. That's it for now. Looking ahead, the German Business Climate Index is revealed on Tuesday when we get the final estimate of Dutch economic growth. GDP figures for the UK and the US are out on Thursday, and German inflation data are released on Friday. Thank you for watching and see you soon.